the best of Money Matters.
Market View on Money FM 89.3.
That's right. You're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. The SCI closed down at 0.05% at 3,964 points. In Asia, China's factory activity is showing signs of stabilizing after a trade truce with the U.S., though weak domestic demand continues to weigh on the economy. Meanwhile, markets are watching Japan, waiting for clues on the Bank of Japan's next policy move. In the U.S., tech giants like Meta are back in the spotlight amid regulatory risks and AI ambitions. And globally, investors are bracing for potential turbulence as President Trump's tariff deadlines approach, threatening new duties on America's trading partners. Now for more market moves and views, joining us today is David Kuo, co-founder of The Smart Investor. Hi, David. Welcome back to the show. And happy Monday.
Happy Monday, Alex. Is it a happy Monday? Really?
Hopefully it is a happy Monday.
We'll see how happy it really is, Alex. Yeah, okay.
Okay, so maybe let's start with the SCI. It opened in the green earlier at 3,970 points. So what do you think drove market sentiment this morning? Any major movements being led by specific sectors?
Well, there was certainly a big difference between the way it opened and the way it closed. It closed in the red today, so I guess market sentiment changed a little during the day. But what is noticeable today is that many of the gainers were primarily real estate investment trusts or REITs, which is a popular investment here in Singapore. So I guess what the market is thinking right now is that maybe interest rates could be heading lower. It already is lower in many parts of Asia, but the big gorilla, the Fed, has yet to decide what to do with interest rates. So maybe the market is preempting it slightly, and they think that maybe the Fed will move lower on interest rates sooner than expected.
Now, China's official manufacturing PMI in June rose slightly to 49.7 from 49.5 in May. So how do you think investors should interpret this? Is it a sign of the economy stabilizing, or does it simply mean conditions are still weak?
Well, 49.7 is still contraction. Anything less than 50 is a contraction mode. So it looks as though, yes, things maybe improved a little in China. It didn't shrink as much as it did last month, but it is still contracting. And is the worst over for China? Maybe, yeah. Maybe there is some slight improvement. So we need another set of data to decide whether or not there is some kind of expansion over in China. As far as investors are concerned, I think they're in a kind of wait-and-see mode at the moment, and hopefully things will start to improve in China, particularly when the tariff talks between America and China seem to be heading in the right direction at the moment. So fingers crossed everything is on track, and maybe China will start expanding again.
But its non-manufacturing PMI actually inched up to 50.5. So do you think China's services and construction sector is enough to offset the continued drag from manufacturing?
Well, this is what China is hoping for, that maybe they will be able to get one part of the economy moving, in particular consumer spending. I think in order to achieve that, China will have to pump more money in. And so the one thing to watch really is the Chinese stock market over the next couple of days or couple of weeks and see whether or not China is going to start pumping more money in fiscally in order to drive its economy. It needs something because it looks as though exports aren't really that strong right now, so it needs consumer spending. And that really is China's big plan. They want the consumers to drive the economy in much the same way as many developed economies have already done so. So in America, consumers drive the economy. In Europe, consumers drive the economy. Here in Singapore, consumers drive the economy. So I think China wants to achieve the same thing, but in order to do that, they really need to put money into the pocket of consumers to give them the confidence to go along and do that. The thing about confidence is when you do get confidence, then confidence propels more confidence. And that is something that China is hoping for right now.
But several banks actually raised China's growth forecasts for 2025. But economists still expect GDP growth this year at around 4.5%, which is actually below the official 5% target. So is this a reason for investors to be cautious, or does it create opportunities in Chinese equities or even bonds? And Are there particular sectors or industries in China you'd see as attractive for investors right now?
Well, I think, most people are of the opinion that maybe it is the tech space that is the most exciting in China right now. We've already seen that many of the technology companies in China are competing on almost a level footing with those in America. So if investors are interested in investing in China, then maybe the tech industry. But for me personally, the tech industry is too complicated, and I much prefer some of the old, boring, old-world economies. So I quite like things like bubble tea, food, restaurants, that kind of stuff. And if China's economy is going to start improving, and if China does get its wish, which is that consumers are going to drive the economy forward, then I think that kind of old-world economy is more appealing to me, particularly if they pay dividends, Alex.
Now, still in Asia, Japan's industrial output rose just 0.5% in May compared to the previous month, which was well below the market forecast of a 3.5% increase. And meanwhile, the country faces potential U.S. tariffs of 25% on automobiles and even a possible 24% reciprocal tariff starting July 9 if no deal is struck. So how much of a threat do these U.S. tariffs pose for Japan's manufacturing sector?
Absolutely huge, Alex. And I think we cannot draw parallels between what is going on in Japan and what has happened in China. I think in the case of China, they had an ace up their sleeve, and that ace was the rare earth metals. And they could actually use that as a kind of bargaining tool. But in the case of Japan, they don't really have an ace up their sleeves. And so I think when you have a look at the two economies, what does Japan have to offer America? I think the only thing they do have to offer America is maybe 135 million consumers in Japan. And in order to do that, they will have to lower the tariff on American-made products and maybe allow consumers to choose. Now, this big sticking point right now is Japanese cars. We know that Japan is an export-led economy. They make a lot of cars, and they sell a lot of cars to America. But with a 25% tariff on Japanese-made cars, it means Japan's economy is going to find it very difficult to expand because they're not going to be able to export their cars to America. So I guess the best thing really is for Japan to drop its tariffs on American-made cars and let the Japanese consumers decide. Do you want to buy a Ford or do you want to buy a Toyota? Just let the Japanese people decide for themselves. Because, the last time I went to Japan, I didn't see many American-made cars. And I guess the argument there was that they prefer Japanese-made ones. So the Japanese consumers decide for themselves rather than have these import tariffs. And if they drop the tariffs, then, of course, Donald Trump or the Trump administration will probably reciprocate in some ways and say, if you drop your tariffs, then we will drop our tariffs on Japanese-made cars coming into America.
But with Japan's economy already fragile and private consumption subdued, is this an opportunity for investors or should they remain cautious then?
Well, it really depends on who blinks first. The key really is the tariff negotiations between the two countries. And if they do come to some kind of resolution between Japan and China, and they do drop the tariffs, then I would say, Japan is definitely a place where you can consider investing. Because there are many wonderful companies in Japan, things that you can't really sort of find elsewhere. So the likes of Sony, Hitachi, the Japanese car manufacturers, these are all great companies to invest in for the long term. But it really depends on how those tariff negotiations are going. But the last time I read, I think the Prime Minister of Japan, Ishiba, said they're still in the fog at the moment. In other words, they can't see their way out of this mist that is clouding the Japanese economy.
Now, switching gears to the tech world, Meta has reportedly offered $100 million or 127.5 million Sing dollars bonuses to poach AI talent and recently paid over $14 billion or 17.8 billion Sing dollars or a 49% stake in Scale AI. Do you think this aggressive spending on AI talent and acquisitions is sustainable for Meta, or could it eventually backfire?
Don't you wish you studied IT at university, Alex, rather than media? I mean, don't you wish that somebody offered you $100 million bonus, signing on bonus, to go and join Meta? Joking aside, yes, a lot of companies are throwing a lot of money at AI. Meta has been probably a little slow compared to some of the other leaders. So it's got to play catch up. And I think the way that it can do that is to offer big bonuses to try and attract talent. But I think investors are getting a little worried right now, Alex, because they're saying 100 million here, 100 million there. Before long, we're talking about billions and billions of dollars being thrown at AI. And show me the money. Where is the returns from this? And as with all technology, what was actually noticed is that there are lots of players in the field, but not everybody can possibly be a winner. And so if you are going to be playing this game, it's almost like playing roulette. So out of 36 numbers on a roulette wheel? Well, only one can win. But in this case, there will be a handful of winners, but there'll be lots of losers, which therefore means that a lot of companies will be throwing money at AI and they're going to see no return. And those investors are going to be very disappointed, if not angry, that the companies have misspent their funds.
Yeah, actually, you were right, because some investors are actually worried about Meta's massive spending despite the company's strong share price. So what does this mean for investors then? Is it time for patience or caution?
Well, I'm old enough to remember the dot-com bubble. And at that time, we thought that every company was going to be a winner. And, of course, people who invested in those dot-com companies, well, some of them went away empty-handed. And I think the same situation is here. So if you are going to be investing in this industry, I just take the cautious view and I just invest in what I call the spades and shovel side of the business. So I much prefer things like energy producing companies, energy generators, because I know that many of the data centers will be requiring energy. So I don't really care whether Meta wins or loses the AI war. All I do know is that if Meta is going to be investing in these large language models and training the large language models in order to cope with AI, well, they're going to need a lot of energy. So I'll just give them as much energy as they want, and I'm going to get paid in the meantime. And as far as who the winners are going to be from this AI evolution, I have no idea. And I think I'm honest enough to say that I really am not sure who is going to be a winner here.
Now, looking over to the U.S., its tariff deadline is actually looming on July 9th. And while the White House has struck deals with China and the U.K. and many other agreements look limited, there's uncertainty about whether tariffs of up to 25% might be imposed on other trading partners. Trump's trade truce with China looks like it bought some time, but many deals are reportedly just frameworks rather than full agreements. How much confidence should investors place in these partial deals?
None whatsoever, quite frankly. I mean, some of them are just memorandums of understanding. So all it is really is that, okay, we're going to carry on talking about something. The China negotiations is interesting because America needs those rare earth metals and China says, okay, we'll do that and then we'll carry on talking about some other things. So, yeah, when Donald Trump came out and he talked about, the kind of deals that people were beating a path to his door and his phone was ringing off the hook because there were so many countries wanting to do deals. Well, quite frankly, I haven't seen any deals whatsoever. I think even the UK one is just a memorandum of understanding between the two countries. And no country really wants to sign a deal, particularly when they've discovered that in some cases, the Trump administration has just backed down completely. So why would you want to sign a deal when somebody else who hasn't signed a deal gets a better deal because the administration has backed down? I mean, there are over 200 countries in the world, and yet only 2 so far have actually sort of done anything. So there's still 198 deals to be done. Will it be done by the deadline date? Hardly, I think. I'm just quite disappointed. Actually, I'm not disappointed because I probably saw it coming anyway.
But we've seen Trump actually pull back from tariff threats at the last minute before. So do you think markets are rightly pricing in a taco scenario? Trump always chickens out, or could this time be different?
Well, I think what we're seeing at the moment is that the Trump administration is very good at distraction. So what they tend to do is to distract the market over all sorts of things by waging a war against Iran, by waging wars and distracting the market with all sorts of things that are going on. that are totally irrelevant. I mean, the two big things really is the budget, and there are doubts as to whether or not the budget will be passed. And secondly, it's tariffs. And both those things haven't really happened yet. And so, yeah, I think the market is skeptical at the moment about whether or not anything can really be done. As far as that budget is concerned, I mean, that is the one thing that worries me more than anything, because it is going to keep loads and loads of debt onto American consumers, and how they're going to finance that debt, I have absolutely no idea. So it's going to be interesting times at the moment, Alex.
And before we let you go, David, anything else you'll be looking at in the week ahead?
Oh, yeah, payroll numbers. I think unemployment numbers in America, that is going to be key. And if unemployment starts to rise in America, then I think it puts the Fed in a very difficult position, because it has this dual mandate. It's got to control inflation, and at the same time, it has to ensure full employment in America. But if unemployment starts to creep up, it means that interest rates have to come down. But if the economy is still doing okay, then why would it need to do that? So I feel sorry for Jerome Powell at the moment, the Fed chair, because he's probably going to come under a lot of pressure from the administration to cut interest rates, whether the country needs it or not.
Well, thank you so much for joining us today, David.
You're welcome. And was it a happy Monday?
Yes, happy Monday.
Okay, very good.
That was David Kuo, co-founder of The Smart Investor. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.